Hi there, you're watching Market Cafe on ET Now with me, Shreyanshi Singh, and with me as always is my co-anchor Snehi Shah. Over the next 1 hour, we'll take you through news and updates from within the country as well as across the globe, tell you which stocks you should keep on your radar and tell you what the brokerages are saying as well. But Snehi, first things first, there's only one big headline to look at this morning.
Absolutely, Shreyanshi, we're, gearing for today, heading to bed and, phone is going off. You have news and updates coming in from the US. Hi there, good morning. Before we start talking about the biggest headline last night, and that is Biden, quickly let's take a look at what GIFT Nifty is doing. More than a 100-point cut coming in. Let's understand why there is so much pressure, and a big part of it has to do with geopolitical instances happening, and in what appears to be the biggest twist so far in the run-up to the US presidential elections, the incumbent president of the United States, Joe Biden, has decided to withdraw his candidature against Donald Trump. Late last night, the US president released a statement on social networking website X, where he confirmed he would not be running for re-election. In his statement, he said it was the greatest honor of his life to serve as president, and while it was his intention to seek re-election, it's in the best interest of the party and the nation that he has decided to stand down. Joe Biden says he will now focus on fulfilling his duty for the remainder of his term and speak later this week in detail about his decision.
Well, absolutely. And on that note, let's also listen into what Josh Book of the Associated Press also had to say about this then.
It's a historical moment. Joe Biden is not going to be the Democratic presidential nominee. He's out of the race, and there's two big reasons for this. The first was his debate performance against Donald Trump. He showed his full 81 years. He stammered, he struggled to answer, he struggled to fight for himself, let alone the American people who he says he's defending. This caused panic among donors and fellow lawmakers and raised fundamental questions about his age. The second major factor in this was the Democrats' own anxiety about beating Trump. They see a second Trump presidency as a danger to democracy, a possible end of the constitutional republic. They look at the ideas floated by Trump on tariffs as making inflation worse. They worry about the debt. They worry about international alliances. They fear Trump. And that overriding fear of Trump is what compelled them to say they needed another candidate for president. It looks like Vice President Kamala Harris is going to face Donald Trump in November. Harris finds herself in something of an unusual position. She was Joe Biden's vice president, and now, after much debate and drama, she's the Democrats' presidential candidate. Her background is unique, particularly because Harris exemplifies two key coalitions that Democrats need to have turn out in November. Not only is she a woman, but she's a woman of color with both South Asian and black heritage. Those groups, women and non-white voters, have been key Democratic coalitions. And this will be a test of her ability to turn them out. We've seen as the campaign got closer that the former California senator and California state attorney general has focused on issues like abortion, on issues like voting rights, appealing specifically to those blocs. That's something of a difference from the start of her time in the Biden administration, when she was more focused on countries in Central America regarding immigration and kind of going out as a general surrogate for the president. Now, she needs to show that she can take those issues and build on them more and more on issues involving the economy, national security, and climate change. What Democrats say they want is a fighter. And in Harris, they have someone who's had many stare downs in Senate committee hearings and in courtrooms. But now that stare...
Well, Snehi, what really stands out to me is that there was already a lot of pressure building on Biden to bow out of the race. There was a lot of analysis on that and a lot of people penciling in that he might do this. But what's interesting right now is that he's bowed out, but he's also nominated Kamala Harris. And he's not the only one who's backing Kamala Harris at this point, because you do have Bill Clinton as well as Hillary Clinton, who've also gone ahead and said that they're backing Kamala Harris as well. Staying with US presidential elections, then Republican presidential candidate Donald Trump reacted to Biden's endorsement of Kamala Harris, and he said he believes she will be easier to defeat in November's election than President Joe Biden. Trump and his campaign later also attacked Biden and Harris on social media while saying Biden was unfit to continue serving as president. On social media platforms as well, Trump said that Biden was not fit to run for president and is certainly not fit to serve. So that's the latest coming in there in terms of what Trump had to say as well.
Absolutely quite the statement, if you ask me, that Trump uploaded on social media last night. But meanwhile, reactions from across the globe have started to trickle in. A whole host of leaders are lauding Joe Biden's move to step down from the presidential race. Now, you have Canadian Prime Minister Justin Trudeau. He has said that Biden's decision to drop out of the race was deeply rooted and guided by his love for the country, and that he is a true friend to Canada. Shifting focus, let's talk about Germany. Meanwhile, the German Chancellor Olaf Scholz has expressed gratitude towards Biden. Alongside, he also added that Biden's decision deserves more recognition. Let's also talk about newly elected British Prime Minister Keir Starmer. He said that he respected Biden's decision and looked forward to working with him for the rest of his term. But you know what's surprising is that Obama and Pelosi have not specified if they are endorsing VP Kamala Harris for the presidential election. They've praised President Joe Biden's decision to step aside, but they have not yet made their stance clear on whether they will be backing Kamala Harris. So we'll be waiting for some development on that front as well, Shansi. Very interesting.
Well, absolutely, that is interesting indeed. But let's also take a look at what oil prices had to do then. In terms of what oil prices did, you do have oil prices dropping on Friday by more than $2. But you know, before we come to that, let's also take a look at what S&P 500 futures did, right, Snehi?
Absolutely. Lots to talk about, and volatility in the US definitely is what the futures were pricing in on the back of the decision of Biden to step down last evening. S&P 500 futures inched up Sunday night after the broad market index suffered its worst weekly losses since April last week as investors rotated out of mega cap tech stocks for smaller names. Futures tied to the broad market index gained 0.2%. Now you had Dow and Nasdaq. These futures have added 0.1% and 0.4% respectively. So lots to watch out for. In fact, when we take a look at what the US futures are doing as of now before the market opens, and well, that's largely what the pre-market is looking like. As of now, all futures looking to be in the green, but let's see how long they can hold on to that. Traders are also keeping an eye on the US political landscape, like we just told you about. Lots of action happening on that front as well. And earnings and central bank policy will also be on the top of investors' minds. Traders have been pricing in a nearly 93% likelihood that the Fed Reserve will cut interest rates during its September meeting. With this in mind, investors have been selling off the big tech winners of the market rally in favor of rate-sensitive stocks such as small caps and industrials that stand to benefit from lower rates. Now, during the previous trading week, the S&P 500 and Nasdaq each fell 2% and 3.7% respectively, marking their biggest weekly losses since April. On the other hand, the Dow advanced 0.7%, so that's an outlier over there, while the small cap focused Russell 2000 gained 1.7%. On the earnings front, investors will be looking towards to Verizon's quarterly results Monday morning before the US market opens. No major economic updates are expected until later in the week, and well, next week you also have the FOMC meeting, so lots to watch out for. But Shansi, also tell us what the world of crude is up to.
Well, absolutely. When you take a look at oil prices, like I mentioned, they dropped on Friday. So that's the kind of move that we've seen coming in for oil prices. When I take a look at Brent crude futures, I'm looking at declines coming in of about 2.9%. So it was around those $82 a barrel levels. And when you take a look at US WTI as well, you're looking at similar moves coming, but a darker shade of red, if you will, because there's a 3.2% decline coming in for US WTI as well, and that was around those $80 a barrel levels as well. Now, US Secretary of State Antony Blinken also said on Friday that a long-sought ceasefire between Israel and the Palestinian militant group Hamas was within sight. So that is something that he talked about as well. And that, of course, is something that has been on the minds of the market as well for a very long time at this point. Now, if a ceasefire is reached, the Iran-backed Houthi rebels could ease their attacks of commercial vessels in the Red Sea. And that is an important move coming in as well that we're keeping an eye on, since the group declared the attacks in support of the Palestinian military group. As well as what we've seen is that this is something that the market has kept a very close eye on, and for the right reasons as well, because there are a lot of important trade routes in that area that the market is looking at. Now, the US dollar index also climbed after stronger than expected data on the US labor market as well as manufacturing earlier in the week, and that is something that we saw pressuring oil prices as well. A stronger US currency, mind you, dampens demand for dollar denominated oil from buyers of other currencies as well. Now, elsewhere, Chinese officials acknowledged on Friday that the sweeping list of economic goals that was re-emphasized at the end of a key Communist Party meeting, that carries many complex contradictions, and that is the wording that they've used, pointing to a bumpy road ahead for policy implementation as well. In terms of other data sets from China, China's economy grew by a slower than expected 4.7% in the second quarter, according to official data, and that is, of course, sparking concerns over its demand for oil. And China is an important buyer of oil, so all of that is really very important for the oil markets. But let's move on and take a look at gold then, because gold prices dipped more than 2%, and that was after that stellar rise that we saw coming in for gold after it hit all-time peak earlier this week. And that was fueled by rising expectations of US interest rate cuts in September that are still growing. But what we've seen come in for gold prices is a little bit of profit booking, or a lot bit of profit booking on that note, Snehi, coming in for gold prices after that nice peak that we saw for them.
Absolutely. So some correction due on that part as well. I'll take a look at what the Nifty implied is showing. Some correction due on our markets as well, and doesn't look very optimistic, especially before the union budget tomorrow, the biggest event for us to watch out for. But before that, let's also take a look at all the important cues to watch out for today. And back home today, monsoon session begins in the Parliament. FM Nirmala Sitharaman will be tabling the economic survey 2024-25. So that's going to be a very key event to watch out for as well. Moving on, let's talk about Eurozone. Some Eurogroup meetings will be taking place. From China, we do have the loan prime rates numbers, which we'll take you through in just a bit. Lots of action has happened on that front as well. But let's shift focus back home, talk about some corporate action. Today is the last day to buy shares of Happy Forgings as well as Chembon Chemicals to be eligible for their final dividend. And in terms of earnings, no Nifty earnings today. But from the broader market, you do have a whole host of names like Dodla Dairy, Coforge, IDBI Bank, you have Suzlon, you have Solara Active, Jana Small Finance, lots of names trickling in with their quarter one numbers. And in terms of some other news then, Israeli Prime Minister Benjamin Netanyahu was all set to meet Biden today. Let's see what happens on that front now that Biden has withdrawn out of the race, but continues to serve his term for the rest of, till the election comes. So this meeting is going to be crucial to watch out for. And the Supreme Court will also be hearing pleas related to the NEET UG 2024 case. So lots to watch out for today. Keep a close eye on all of these cues.
Well, absolutely, lots to watch out for, and let's also take a look at some of these plane makers and chart the wins in their sales, because European plane maker Airbus has shortlisted 8 sites in India to open its second assembly line in the country in partnership with Tata Advanced Systems. The second plant will make the H125 and will be the 4th for the single-engine helicopter after factories in France, Brazil as well as the US. It will produce around 10 helicopters a year, with the first of these debuting in early 2026. The company also expects the Indian subcontinent, excluding Pakistan, to be a market for about 500 such helicopters over the next 20 years.
Let's keep it going with all these plane makers, and meanwhile, US plane maker Boeing expects a significant improvement in production flow at its 737 MAX factory as the plane maker battles to overcome a safety crisis. Speaking to reporter Stephanie Pope said that the changes being made to the Seattle factory area was significant. Meanwhile, the head of the company's defense and space division signaled that the unit was having a tough quarter.
Alright, then with that, it's time for a quick break right here on Market Cafe. But when we come back, we'll take a look at how the Asian markets are faring, so you don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, as promised, let's take a look at the Asian markets then. And Asia Pacific markets largely fell as news emerged that US President Joe Biden had dropped out of the presidential race. Investors will also, of course, be assessing the impact of the massive global IT outage that we saw, because machines running Microsoft Windows operating system also crashed on Friday due to a glitch in an update that was issued by cybersecurity company CrowdStrike, plunging its shares 11%. So that is something that we saw, the blue screen of death, like it's called, and the impact of that can be seen, or rather that is also something that we're keeping on our radar this morning. But on Monday, focus will be on the People's Bank of China's loan prime rate decision, with the 1-year and 5-year loan prime rate expected to be unchanged at 3.45% as well as 3.95% respectively. And this is exactly what is being penciled in when it comes to these rates. On your screens, you do have Shanghai coming in with a downtick of 0.5% for that one. Let's also take a look at Hang Seng then. On your screens, a lighter shade of red, if you will, for Hang Seng, with that 0.2% decline coming in for that one. The 1-year LPR, mind you, acts as the benchmark for most corporate loans, and the 5-year LPR serves as a reference rate for mortgages as well. So on your screens, you did see Hang Seng and Shanghai both in the red, but Shanghai deeper cuts is what we're seeing for that one. This week, investors will also be looking out for GDP data from South Korea as well as the US, as well as factory activity data from around the region. So South Korea and the US will be announcing second quarter advanced GDP numbers later this week. Let's also take a look at South Korea's KOSPI, and that one is about 1.2% lower as we speak. So sharp cuts coming in for that one. Let's also take a look at Japan's Nikkei then, because that one is also in the red, downtick of about 0.8% coming in for that one. Now, it's important to note that this was the first time in 3 weeks that the index dipped below the 40,000 mark. So important levels coming in for that one. Let's also lastly take a look at ASX 200. That was earlier leading losses, but currently it's down about 0.7%, 0.8% rather, if we round it off. And then that's the kind of handover that we're seeing coming in for the Asian markets. Now back home, we of course shut shop around the 24,530 levels. And what is being penciled in terms of the Nifty implied is a decent downtick, rather quite the paradox, but a decent downtick is what we're looking at least on a spot basis, and even on a futures basis, we're not looking at a good start at all, Snehi.
Absolutely, seeming to be rather weak. But before we move on, I just want to quickly come back and mark Shanghai, because we do have those China numbers that Shreyansi was talking about, and 3 sets of numbers to watch out for. People's Banks of China has a cut rate for its 7-day reverse repo to 1.7 from 1.8%. The 1-year loan prime rate has also fallen to 3.35% versus the estimate of 3.45% that Shreyansi just spoke about. And lastly, China's 5-year loan prime rate has also fallen to 3.85% versus the estimate of 3.95%. So on the back of that, you're seeing some weakness coming in on Shanghai. Shanghai 0.5% lower and continues to fall after these numbers have come out. So, but well, yes, that was the update coming in on China. But let's move on then. And we're just getting word from Kamala Harris. We're getting updates coming in from the US on behalf of the American people. I thank Joe Biden for his extraordinary leadership as President of the United States and for the decades of service to our country. I am honored to have the President's endorsement, and my intention is to earn and win this nomination, is the word that's coming in from Kamala Harris as of now. And we're bringing you live updates here on ET Now on Market Cafe. But with that, let's also take a look at all of the guests we have lined up for you today. It's a power-packed lineup today. Lots to talk about, lots to watch out for as well. 9:20 a.m. we'll be joined by Madhu Kela, market veteran, and he's going to be here to talk about the budget and the market, especially the kind of fall we've seen in the market recently and how to navigate and go about the budget decision and the budget outcome that comes out tomorrow. Moving on, let's talk about the growth roadmap that will be shared by the Indian Hotels Company. IHCL MD and CEO Puneet Chhatwal will be joining us at 9:45. Remember, inline set of numbers coming in from this company, so we'll just be talking about what the road ahead looks like. Moving on at 10, let's keep it going with earnings. Arun Maheshwari, Joint MD and CEO at JSW Infrastructure, joining us to talk about the earnings. At 10:10, we also have the management of Union Bank of India that will be joining us to talk about their earnings as well. A rather poor set of numbers coming in this time. So Sri Ram Subramaniam S, the Executive Director, will be here to talk about what went wrong and the growth path going ahead as well. At 10:30, we'll be joined by Yugal Sikri, the CEO at RPG Life Sciences. A decent and inline set of numbers coming in, so we'll be talking about what lies ahead. Keep it going with earnings then at 10:40. Jayant Acharya, the joint MD and CEO at JSW Steel, will be joining us. A poor set of numbers coming in, so we'll be talking about everything that happened in the first quarter and the outlook going ahead. And lastly, we'll also be joined by the management of ICICI Lombard General Insurance. The CFO and CRO Gopal Balachandran will be joining us to talk about the company's numbers as well. And a good set of numbers coming in this time around, so we'll be talking about what the outlook looks like and the companies or the bank's actions to go ahead and talk about their growth trajectory as well. So lots to watch out for and lots to talk out for, lots of managements to talk about their earnings as well. So we'll keep a close eye on everything that happens here at ET Now.
Alright, then we have a power pack lineup for you on the channel, so stay tuned and keep watching ET Now.
Hi there, welcome back. You're still watching Market Cafe on ET Now. Let's quickly talk about big boy Reliance's numbers that trickled in on Friday post-market hours. Largely a miss coming in on all fronts. Revenue was down 2% sequentially, EBITDA down 9%. Margins largely in line with what the street was expecting at 16.7%, and PAT was down 20%. So that's a little disappointing coming in. O2C EBITDA has also fallen 22%, retail EBITDA down 3%, oil and gas EBITDA is also down 7%. Now this is the biggest sequential drop in EBITDA in the last 7 years as well. So, these are in a nutshell what Reliance's numbers look like. Quickly also going to Reliance Jio, let's take a look at those numbers as well. Revenue EBITDA up 2% sequentially, margins at 52.6, slight expansion on that front. Net profit also up 2%, but ARPU was flat at 181.7 rupees. So, those were in a nutshell Jio's numbers as well. Growth was aided by subscriber addition. Overall, it's a miss coming in. O2C business, it's a miss. Retail business also a miss. Gas exploration largely in line, and telecom business also largely in line. That's what Reliance's numbers look like.
Well, absolutely, and let's also take a look at what Brokerages had to say then. When you take a look at the view coming in from Macquarie, they have a neutral rating, but they've hiked the target to 2,750 from 2,630. What they're highlighting is a material miss across Jio, retail, oil to chemicals as well. And they're also continuing to see downside to consensus EPS when we take a look at what Macquarie had to say about the big boy Reliance. And they're also talking about how consensus earnings updrift is something that they see meeting a roadblock. So that is something that they've also highlighted. Let's also take a look at what Jefferies had to say then. They have a buy rating on Reliance and they're cutting the target price to 3,525 from 3,580. They're talking about how rationalizing unprofitable parts in retail as well as focus on margin is something that the management has. And Jio should see strong growth post-tariff hike is something that they're also highlighting. In terms of their outlook on O2C profitability, that remains rather subdued in calendar year 24. So that is also something that Jefferies is highlighting. So that is the view coming in from both Macquarie and Jefferies. Neutral rating from Macquarie, but a hike in the target price, and a buy rating from Jefferies, but a cut in the target price coming in for Reliance then. But let's also move on and let's also take a look at what experts had to say, because we spoke with experts to get a sense of these numbers. Here's what we got from Mayuresh Joshi then.
O2C has been a slight miss, but we need to also understand that the overall environment where Reliance is operating in the O2C business has not picked up substantially. There is still hope that in the next few quarters, there will be some respite that comes through this line of business, which can provide comfort to the overall consolidated numbers. The second aspect, obviously, is in terms of their retail-facing businesses. Reliance Retail, a slight miss. One really needs to see the appropriate reasons for the slight miss that has probably come through. Jio, not too perturbed because the expectation largely is with the price hikes that they have taken. There will be some element of earnings improvement that will be on Jio standalone numbers that will take place. And even on the E&P side, which is the upstream business, there should be significant amount of improvement that you will probably see.
Alright, let's shift focus from one market major, Reliance, talk about the other, and that's HDFC Bank reported a good set of numbers for the quarter gone by. Net interest income rose 2.6% sequentially, while net profit has fallen 2% in the same period. The private lender also saw some deterioration in its asset quality, with GNPA at 1.33% versus 1.24% in the previous quarter. My colleague Gaurav is standing by with more details and a breakdown of what these numbers look like. Gaurav, good morning. Take it away.
HDFC Bank came up with their Q1 numbers, which were actually in line with what the street was expecting. Because when we look at the interest income, that increased almost by 2.2% on a sequential basis, while net interest income increased almost by 2.6%. PAT saw a decline of around 2% on a sequential basis, while PPOP was down almost by 18.4%. But all this was already penciled in by the analyst if you look at the pre-quarterly updates. When we talk about the overall asset quality, there we saw a little bit of deterioration. GNPA deteriorated almost by 9 basis points, while NNPS increased almost by 6 basis points on a quarter-on-quarter basis. But let's not forget that in this quarter, Agribic was something where the concerns were building, and this was already penciled in by the street again. When we talk about the pre-quarterly updates, we have already seen a poor set of numbers from the bank because deposits reported a muted growth, while advances shown a degrowth of around 1% on a sequential basis. But all in all, when we talk about the Q1 numbers, there we saw some kind of inline set of numbers from the bank reporting for the quarter. Lastly, let's also not forget that net interest margins came at 3.47%, which shows an uptick of around 3 basis points on a sequential basis, which is again a positive thing for the bank because street was more or less penciling in a flattish net interest margins in this quarter. So definitely watching out on how it pans out for the investors, because on the numbers front we have seen inline set of numbers, while net interest margins have actually came up at a positive surprise for investors.
Alright, thanks Gaurav for that update coming in. Let's also listen into what the management had to say about the operating expenses on the conference call as well then.
The operating expenses has to be looked at in two lights, right? One is 166 billion rupees for the quarter, an increase of 18%. When you compare it to last year, it has a merger effect because you know that the merger happened 1st of July. So April to June of last year did not have HDFC Limited in it. So that is why year on year when you compare it is 18.2. On the same token, when you look at the expenses 18.2%, you can look at the revenues 23.4%, because that also last year April to June HDFC Limited revenues were not there. So when you look at it comparably, 23.4% in on a reported basis to reported basis, and similarly expenses 18.2 on the comparing the two quarters. However, when you look at the cost to income ratio, it's 41%. Last year same quarter it was 42.8 or something, right? A little more than 42% it was last year. So the cost to income has come down. Efficiency has improved. Now one other way I would draw your attention is also sequential, which means March to June, how did that cost to income move, or how did that cost increase or decrease? You see a decrease, exactly what you alluded to. A staff cost is down. You know that in the March quarter we did have a one-time ex gratia provision of about 1,500 crores. If you adjust for that, that means you take that out and look at it, cost moved by about 1%.
All right, well, that was the word coming in from the management of HDFC Bank. But let's move on, also take a look at what brokerages are making of these numbers. First up, let's begin by what Jefferies has to say. They've maintained a buy rating, but gone ahead and cut the target price from 3,525 rupees earlier to 3,580 rupees. We'll just get that corrected on the plate here. Moving on, let's also talk about what the rationale behind Jefferies is. They say that the Q1 review is in line overall, but the retail has disappointed. Management is rationalizing unprofitable parts in retail with focus on margins going ahead. Jio should see strong growth on the back of the tariff hike, and outlook on O2C profitability remains subdued for calendar year 24 going ahead. So that's the word coming in from Jefferies on Reliance. Moving on, let's also take a look at what Macquarie had to say on Reliance. They've maintained a neutral, hike the target price to 27.50 from 26.30 earlier. Q1 was a material miss against estimates is what they're saying. They continue to see downside to consensus EPS, and consensus earnings updrift meets a roadblock is what they have to say. Also, let's keep it going with more on these HDFC Bank brokerages coming in. We also have Goldman Sachs coming in. Quarter one operational beat, earnings visibility looks like it's improving. Asset quality has remained pristine. GNPA slippage ratio is better than estimate, and they expect rebound from the lows of the core PPOP and ROA in FY24. Coming back, let's also talk about Novama. Retail loans and higher LCAR have aided NIM expansion. The CEO has reiterated that the bank shall likely lower their LDR soon, and asset quality continues to remain strong. Coming back, I just want to quickly correct myself on what the Jefferies view is. They believe that the expansion in margins is a positive. Margins have compensated for a softer balance sheet growth. Slippages have risen largely due to seasonal NPLs, and earnings have softened due to lower NIMs. That is what Jefferies has to say on HDFC Bank. Pardon me, what I said earlier was for Reliance, and they've hiked the target price to 1890 compared to 1880 earlier. So, well, that's the view coming in for HDFC Bank across brokerages.
Well, absolutely, and let's keep it going with banks because Kotak Mahindra Bank also reported a decent set of numbers in Q1. Profit beat estimates steered by an exceptional gain this quarter. My colleague Gaurav is joining in with those details as well. Gaurav?
Kotak Mahindra Bank reported its 1Q numbers, which were actually a little below what the street was expecting, because when we look at interest income, that increased almost by 21%, but net interest income increased almost by 10% on a YY basis, while PPOP shown a growth of around 6%, which was a little below what the street was expecting. Other than that, when we talk about profitability, that increased almost by 80%, but this was because of the one-off gain that bank registered worth around 3,500 crore rupees during this quarter because of the sale of the general insurance segment to Zurich Insurance. Other than that, if we exclude this gain, the profitability comes somewhere near 3,500 crore rupees, which was still a little below what the street was expecting. There was another negative flow in this result, which was net interest margins that came to 5.02% versus what it was at 5.28%, which shows a deterioration of around 26 basis points, which is again lower than the street's expectation of somewhere around 5.2%. When we talk about asset quality, we did not see any kind of risk in the asset quality. In fact, credit cost also came in line with what the street was expecting. When we talk about advances growth, their bank actually reported a positive growth because advances grew almost by 4% on a sequential basis, while deposits were muted when we talk about a sequential growth in this quarter. Specifically in this quarter, we saw CASA at 43.4%, which shown a downtick of around 210 basis points. And on back of this, if we talk about advances and deposits, although advances were at a higher side, we saw a muted growth in deposits. So all in all, a little below expectations, below expected numbers from Kotak Mahindra Bank is what we are seeing in Q1. Definitely watching out on how it pans out for investors.
Gaurav, thanks for taking us through those numbers as well. Let's also listen into what the management of Kotak Mahindra Bank had to say on their conference call.
We can look at unsecured business right up to the mid-teens. Yeah. 3 areas that we consider as unsecured: credit cards, personal loans, and microfinance. On microfinance, as Devang told you, there are many reasons for that. Heat, drought, elections, you can go on. But there were a spot of delinquencies in certain markets, and which is why we pulled back and kept the disbursement steady, and the business is flat right now, and we keep watching for opportunities in recovery. And we think that the rural segment will perhaps do better this year. Cards, we were actually impacted by the embargo, and we only focused on existing customers to drive up their spends. We will continue to focus on both SA, CA, term deposits, and active money, which is a special product that we have that gives us an average cost, which is lower than the term deposits, but higher than savings. And current account, of course, comes with no cost. So we have strategies for each one of them, which we can discuss separately. Strategy is to drive pure savings, active money, where you can sweep your 180 day into 180-day deposit at 7%, and then term deposits. Okay, the average cost of the active money is between 575 to 590. Our strategy will be to drive all these 3 as of now.
All right, and that was the word coming in from the management. Let's also take a quick look at what brokerages had to say about the counter as well. When you take a look at what Jefferies had to say, they have a hold rating. Bernstein has a market perform rating, and Novama has a reduced rating as well. Let's also take a look at what they had to say in terms of a little more detail. Now, adding some color to what Jefferies said, rise in cost of funds is something that they saw impacting NIMs as well. In terms of loan growth, they're talking about how that is led by lower margin segments as well, and slower deposit growth is something that they also flagged when it comes to Kotak Mahindra Bank. Now, in terms of the RBI resolution, they see that as key to watch. And that is the sense that we're getting from the other brokerages as well. Let's also take a look at what Bernstein had to say then. They're talking about how the bank battled headwinds from RBI embargo as well as external environment. So that is something that they're talking about. In terms of other things, they've also talked about how corporate growth is something that boosted loan growth but hurt margins. So that's key commentary coming in from Bernstein. And they're also talking about how the timeline for lifting RBI restrictions is something that is currently a little bit uncertain. So that uncertainty is also what they're highlighting for Kotak Mahindra Bank. And the tougher task of managing growth as well as profitability ahead is also something that Bernstein is keeping on their radar as well. Let's also take a quick look at what Nuvama had to say then, and they're talking about the impact on NIMs in terms of the higher cost of funds as well as lower share of unsecured loans. Lastly, let's also look at what else Nuvama had to say. They talked about how the bank is working hard to correct gaps pointed by the RBI. So that's key commentary coming in from Nuvama as well when it comes to Kotak Mahindra Bank.
Absolutely. Lots of banks coming out with their numbers and lots to watch out for in terms of how the market reacts to that today as well. But on that note, we'll slip into a very short breather on this edition of Market Cafe. More stock-specific news and updates on the other side when we return.
Welcome back. Thank you so much for staying tuned in. Well, the countdown to the biggest event for the market, will the union budget cheer the bull run, or are we in store for a short-term correction? What will the finance minister's focus be on? ET Now conducted a CIO survey to understand the pulse of the market. Anisha Jain is here with the highlights. Anisha.
ET Now is back with the CIO poll, and this time we put the spotlight on the impending budget and we posed the questions around that to the top CIOs and the market men. And the first question, of course, was what would be the biggest focus area of this budget? Clear indication coming in that infrastructure, which has been the focus point of the government, is something which is likely to continue. Others believe that social spending might get a bit of a fillip. So there are some 42% people who believe that social spending could be the focus area, but not much expectation with respect to tax rationalization or a special push to manufacturing. The other question we posed to the market guys was whether there is a possibility of a big sell-off post the budget. Now, of course, it's a 50-50% scenario there. But if you look at it, almost 70% of the people believe that no, there is not a possibility of a huge sell-off, though there are some, almost 30-35% people believe that there could be a correction in store for us post the budget as well. What could be the measures which could be announced then in the budget? Will there be any measure to curtail the F&O speculation and the F&O speculative trading? Well, large part of the street is mentally prepared for any such announcement coming in. Almost 67% people believe it is impending. Capital gains, that continues to be the big chatter around the budget time. However, this time around, almost 67% people believe that there is no expectation right now for tinkering in the capital gains tax. Yes, there's a possibility of it. So 33% people still believe it can happen, but the large part of the street is not expecting a big change there. The next question that we pose is, what about the personal taxation front? Because there's a lot of chatter that consumption still needs a bit of a push. There the street is on board with that fact that there could be a bit of a tinkering as far as the personal taxation is concerned. Maybe the brackets could be expanded so that there is a bit more leeway for consumption to pick up, and that's the verdict that we are witnessing right now. The other questions that we posed included the like of which sectors are the ones which is going to be the focus area. Well, IT, FMCG, pharma, the defensive place pretty much, which hadn't run up as much as the rest of the space, is the place where they're willing to put fresh money to work. There's also energy, defense, power that continues to be in the focus area. Financials, interestingly, has underperformed massively, but if you're looking at the second order of preference, financial finds its mention there. So interesting bit coming in there. A couple of other questions that we asked them was what they're most worried about in the markets right now, whether it's earnings, whether it's the FOMO feeling and the liquidity, or whether it's the valuations. Large part of the street is still worried about valuations. They're not worried about earnings. So fundamentals are not the worry area for them. It's the valuation and the FOMO feeling. And the biggest question of it all, of course, what could be the nifty high for the year? A couple of people replied that they do anticipate 27,000 on the index by the end of the year, but the large part of the street was concentrated around 25,500 to 26,000. So maybe, Ajay, we are in for a nifty rally, which is almost 1,500 points from here on till the end of the year. But yes, not perhaps at 27,000 on the nifty this year. That's what market men are telling us.
All right, Anisha, thanks so much. Very interesting poll coming in of CIO before the budget with key expectations. So very well summed up, Anisha. Thank you so much for that. But on that note, we're completely timed out on this edition of Market Cafe. From Shreyansi, me and the entire team that put this show together, thank you so much for watching. And while we bid you goodbye, you stay tuned to the channel because the market takes all the action forward.
If you like this video, then like, share and subscribe to ET Now.